I built a property management company specifically because I kept watching investors get destroyed by the people they hire to protect their assets. Deferred maintenance, bad tenant screening, no systems in place. I've seen a lot of good rentals turn into money pits inside of 18 months. And this is how it happens and how you stop it before it costs you money. If this is your first time here, do me a favor, hit that like, subscribe, and tap that notification bell. Share this with all your friends. I publish straight talk on real estate investing for veterans and serious civilians who want the unfiltered version. There's no hype, there's no filler. It's just how you execute. My name's Bud Evans. I did 35 years in the U.S. Air Force, 13 years in law enforcement. I'm the former mayor of a small town in New Jersey. I'm an active real estate investor across 3 states, and I'm a founder of a low-cost, investor-focused property management company in South Jersey. I mentor veterans in real estate. That's my background, and that's why I'm here. Let me tell you how a good rental becomes a money pit, because this happens consistently, and I could set a clock to it. An investor buys a solid property. It's not perfect, but it's got good bones. The numbers are going to work on paper. They're going to find a property manager, usually, unfortunately, the first one that they see on Google, or they called the first one that had the nicest website, and then they hand over the keys. They feel relieved. The hard part's done, right? No. Now the asset's managed and the checks will start coming in every month. That's what you think. And you know what? Month 1, the rent comes in and everything looks fine. Month 3, small maintenance issue shows up. The property manager handles it. Invoice seems a little high, but the investor doesn't push back because they don't want to be difficult. And they're really not sure what the repair costs are in that market anyway. Month 6, the tenant calls the property manager about a slow drain. Property manager adds it to the list, but nobody follows up. Drain gets slower, gets clogged, backs up. Now it's a plumbing issue instead of a $15 fix. Month 9, investor gets a statement showing repair invoices totaling $1,800. Why? Well, they call the property manager to ask about it, and the property manager explains that the work was necessary and authorized under the maintenance threshold they had agreed to. The investor doesn't remember what the threshold was because they didn't really read the management agreement carefully. Month 12, tenant gives notice. Property manager schedules a move-out inspection. The investor gets photos of a property that looks a lot worse than it did when the tenant moved in. Property manager says, no, it's normal wear and tear. Security deposit barely covers the cleaning fee. An investor is now facing a turn cost of $4,000 to $6,000. Month 14. Property's been vacant for at least 6 weeks because the property manager listed at a rental price that's above its current market value and hasn't adjusted it. The investor's now carrying the mortgage with no income coming in at all. They call, they go to voicemail. 18 months, that's the sequence. And I've watched it play out so many times. And I started getting calls from investors describing their situation. I could finish the story before they even finished themselves. Financial damage in this scenario is absolutely real. You have the inflated repair invoices, you have the deferred maintenance that compounded into bigger repairs, you have the excessive turn costs, you have 6 weeks of vacancy for mispriced rent. You add it up and you're looking at $10,000 to $16,000 in preventable losses on a single property in 18 months. But here's the part that really stings. The investor didn't make just a bad acquisition decision. They bought a solid property. They made a bad operational decision. They hired without vetting and they managed without oversight. And that's the single operational failure that's going to wipe out more than a year of cash flow. But this isn't a rare story. This is the median experience for investors who treat property management as an afterthought instead of a core function of the investment. Now, let me show you where the systemic failure actually lives, because it's not where most investors think it is. Most investors who get burned by property manager blame the property manager, and sometimes that blame is fully warranted. But guys, extreme ownership here, right? There are bad operators in this industry, but the deeper problem is that the investor never built oversight into their systems. They hired someone and then they disappeared. They checked the monthly statement and assumed that a statement with no emergency calls meant everything's fine. Look, in law enforcement, we had a saying, the absence of a complaint is not the evidence of compliance. It just means that nobody filed a report yet. Same principle applies to property management. No news doesn't mean good operations. It might mean that the problems are just deferred and they haven't surfaced yet. The turning point for investors who stop getting burned is not finding a perfect property manager. Perfect property managers don't exist. I'm not perfect. The turning point here is building a management oversight system so that you know what's happening inside your asset on a regular basis. And that's regardless of whether the property manager volunteers the information. So you got to shift from passive owner to engaged operator, not micromanaging, but engaged. There is a significant difference here. If you're a veteran and you want to learn from people who have already built these systems out and they're actively operating them, get into the war room with David Perret. This is veterans helping veterans navigate the real operational challenges of real estate investing. That's what the room is. It's not theory, it's execution. There's a link in the description. If you want direct time with me, go to budevans.com, book a one-off call. I'll be more than happy to help you in any way that you need. I don't sell a program, so it's not a sales pitch. But here's the system you need. This is how you protect your asset and hold your property manager accountable without turning it into a second job. Step 1, vet before you hire. This sounds obvious, but most investors skip it or they do it superficially. Vetting a property manager means more than just reading a Google review. It means actually calling their current clients and asking specific questions. How do they handle maintenance requests? How fast do they respond to tenant issues? Do they communicate proactively or do you have to chase them around? Have you ever had a dispute with them and how did they handle it? You want at least 3 reference calls with actual current clients, not references the property manager hand selects for you. Ask the property manager to give you references and then ask the references if you can have the contact information for 2 other owners they manage for. Go 1 layer deeper. That second layer is where the real picture is going to live. All right, step 2, read your management agreement before you sign it, all of it. I know that it sounds basic. Investors just don't do it. They skim through it and they sign because they want to get the asset placed and move on. The management agreement is going to define your maintenance authorization threshold, the fee structure, the conditions under which the manager can sign leases on your behalf, the notice requirements of termination, and a dozen other terms that will matter enormously when something goes wrong, and it will go wrong. Know what you agree to before you actually are in a dispute over it. Step 3, set your maintenance authorization threshold deliberately. This is the dollar amount below which the property manager can actually approve repairs without your consent. Most management agreements default to $500. Think carefully about whether or not that number is right for you. Depends on your area. If you set it too low, you're going to get called for every minor repair and the property manager will lose efficiency. If you set it too high, you're going to end up with large invoices you didn't authorize and you didn't even know about. I recommend $250 to $300, $250 to $350. For most single-family rentals, it keeps the manager operational on small items while requiring communication on anything really significant. Step 4, require itemized maintenance reporting. Every repair, every vendor, every invoice, not a summary line on a monthly statement itemized. This does one thing. It tells you which vendors are being used and how often. If the same plumber is billing twice a month at above market rates, you'll see it on an itemized report. You won't see it on a summary statement. Itemized reporting is your audit mechanism, so require it from day 1. Step 5, conduct a property walkthrough every 6 to 12 months. If you're a remote owner, hire a third-party inspector to do this. A $200 inspection every 12 months is the cheapest insurance policy you'll ever buy on a real estate investment. You're looking for deferred maintenance the property manager did not report. You're looking for lease compliance issues the tenant's hoping nobody notices. You're looking for general property condition relative to what it was when the tenant moved in. Don't rely solely on the property manager's word for it, okay? Get eyes on the asset independently. We actually do this for our clients twice a year, and we take photos. Step 6, review your rental rate against the current market comps. Every lease renewal cycle, don't let the property manager set renewal rents without your input. Pull your own rental comps. Call 2 competing property managers and ask them what property type is renting in that zip code right now. If your property manager is renewing leases below market value, you're leaving money on the table. If they're pricing above market and creating vacancy, you're losing money on ego pricing. You need current data and have that conversation with someone in authority. Step 7, build a vendor relationship independent of your property manager. Know who is a reliable plumber in that market. Know who does good HVAC work at a fair price. You don't necessarily use them instead of your property manager's vendors, but knowing the market for common repairs will give you a benchmark to evaluate everything. When a plumber charges you $400 for a repair that typical costs $150, you'll know if you've done your homework. Step 8, establish a communication protocol in writing before the property manager takes over the property. How often do you expect a proactive update? What's the response time expectation when you reach out? What constitutes an emergency that requires immediate notification, regardless of the time? These are not unreasonable expectations. They're honestly operational standards that you need to set. A professional property manager is not going to balk at them. A good property manager who pushes, or a property manager who pushes back hard on communication standards is showing you something important before you've actually handed over your keys. Common mistakes that make this entire system collapse. Here are a few of them. Mistake 1, hiring based on price alone. Oh my God, if I hear one more person ask me what's my rate. The cheapest property management fee on the market is always never the best value. A property manager charging 6% who defers maintenance, places bad tenants, and underprices your rent is costing you far more than a property manager charging you 10 to 12%. Who operates your asset professionally. Evaluate the total cost of ownership, not just the management fee. By God. Mistake 2, failing to enforce the management agreement when the first violation occurs. Look, if the property manager misses communication standard or exceeds the maintenance threshold without notifying you and without authorization, and you let it go, you've already established that the agreement is optional, and it shouldn't be. Address the violation the first time it happens, not aggressively, professionally. Note it, discuss it, document the conversation. Set the standard early, or you're going to spend the life of the relationship enforcing nothing. Mistake 3, keeping a bad property manager because switching feels complicated. Switching property managers is operationally inconvenient. It requires notice period and transition to tenant files and security deposits and a learning curve for the new manager. It's not easy, but keeping a property manager who's actively damaging your asset because switching is hard is a decision that compounds losses every single month you delay it. If your relationship is broken, fix it fast or get rid of it. Mistake 4 is not separating your property reserve account from your operating account. Your property manager should be holding your security deposits in a separate escrow account. You should be holding a maintenance reserve, and it should be funded and identifiable. If your reserve funds are commingled with your property manager's operating account or your own operating account, you have zero visibility into wherever those funds are actually existing when you need them. If your property manager is holding your maintenance and vacancy and capital expense, make sure they're doing it separately. You should be doing that yourself. Mistake 5 is treating a monthly statement as a full accounting of property performance. The monthly statement tells you what the property manager chooses to report. It does not tell you what they choose not to report. Deferred maintenance items, tenant complaints that were dismissed, lease violations that were ignored, none of that's going to show up on your statement. Your oversight systems, your walkthroughs, your itemized reporting, and your vendor benchmarking, that exists specifically to surface what the statement doesn't show you. All right. As always, let's go through your recap checklist. Use this to build your property management oversight system. Before hiring, get your reference calls with at least 3 current clients and go one layer deeper to clients the property manager didn't really select for you. Next, read the full management agreement before signing and understand every term that governs maintenance, authorization fees, and termination. Next, set your maintenance authorization threshold deliberately. Remember, I keep it at 250, but between 250 and 350 is great for most single-family properties. Next, require itemized maintenance reporting from day one, not summary statements. I got burned that way. Schedule an independent property inspection every 6 to 12 months, regardless of what the property manager reports. I do that every 6 months. Pull your own rental comps at every lease renewal cycle and verify the property manager is pricing at or near current markets. I'm not talking about current tenants, okay? You're not going to blast them if the rents in the area go up $600. Next, build an independent knowledge of the market repair costs so you can evaluate invoices with authority. All right, next, establish communication protocols and response time expectations in writing before the asset is placed under management. Guys, address every violation of your management agreement the first time it occurs. Don't let it stand. Don't let standards become optional. If your property management relationship is broken, fix it fast. Delayed action compounds losses. If this gave you something you can use immediately, I'm going to ask you to hit the like, subscribe, and tap the notification bell and share this with someone else it might benefit. This is exactly the kind of content that I put out every week for investors who want to protect what they build. Hey, thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.